Alright, so in this video we're going to go over this two spreadsheets. One is called indexes and then the other one is the key indexes. So what it does, so what I did was I just picked up all the S&P 500 companies, which are around 500 companies, uh, sorted by the market cap, with the Apple being the highest because it has about $2.6 trillion of market cap, followed by Microsoft and so on. So altogether there'll be there are 500 companies here. And then we have the price. So the first time I picked it up was on 323, so that's kind of the price it shows around that time in this column E. Then column F shows the price today. It's just a Google function, Google Finance call. So you can add that to get the today's call. Percentage change, it shows that where's the change in the last couple of weeks and overall the S&P. Now this column H, is the weight in QQQY, because we want to see that if this QQQ is actually when we made this spreadsheet a couple of weeks back, at the time QQQ was really picking up because of the bank crisis as the XLF got sold off. So we had a lot of the money actually went to QQQ. Why? And that's what we're going to start explaining in this video. So that is where it shows that okay, this is actually going to be based on we just change the formatting to this as percentage. So it's 12% of QQQ is Apple, 12.56% is Microsoft, and so on. And then this is actually showing the market cap in this in billion dollar. So you can see that there are 500 companies, so we can do more things with it, but we're going to be mostly spending time on this QQQ index, which is again picked up on 324. So here we have these companies, and here the weight that on the QQQ for that particular stock. Here you can see that Microsoft is the highest weight. What was the price on 323? What was the price today? So what's the change that happened in the last couple of weeks? What is a 52 weeks high? So like Microsoft 52 weeks high was 307 back in March last year, I think around April or May last year. So it's around 7% away from the 52 weeks high. What is its S&P weight, right? So we saw in the previous tab, so what percentage of this S&P is made up using Microsoft or Apple and all these companies here, right? So you can see that and now the delta, before that I go there, the delta of this QQQ here, it basically means that yellow means if I go check the formatting here, so I'll just show you the formatting. So here the rules are if it is very close to 0% from the 52-week high, means it's actually right around there. That is green. If it's 5% below that, so it's not too far away, 5% away, then it's yellow, and otherwise it's more than 20%, means it's actually in the bear market, still very much in the bear market, 50%, 20% lower than the 52-week high, then it's red. So that's kind of the heat map sort of description here. S&P weight means what, as I explained, that what is the weight of that particular stock in the S&P. If it exists in S&P, many of these QQQ companies are not in S&P. So in those cases, is at 0. For example, Biogen is not in S&P, so it's 0% there. Like CrowdStrike is not, etc., etc., etc. So then that's there are total 100 companies here in QQQ. Then we can go and the market cap and then the EPS. So this is actually the EPS reported in last quarter. So for example, for most companies in December quarter, so that was reported in January. So that would be the EPS listed here. Based on that, what is the trailing PE? And the trailing PE is actually listed here. Now I've used Google. I'm going to quickly go over the script that I used to generate this revenue. So you can use this function called the import XML, and then look up for this function index. So what it's really doing is that I have a macro here. Let me just expand this one, and maybe explainable more. Yeah. So here, the way that I picked it up is that instead of copy, I wanted to have this spreadsheet dynamic. So every time the data changes, so I would like to have the data updated here. So that you can do using the Google functions, right? Google Finance function for EPS, for PE, for high, low, current price, market cap, all this stuff. So you can get it using Google function. What you cannot find from the Google function, the two things that I wanted to pick up is the revenue. You can get it the quarterly revenue from the Google search, but not using the Google function, Google Finance function. So there is a workaround to get it directly from in the sheet. There are multiple plugins you can buy to get that information, but you can also get that information for free from just by using the import XML function. So the way that it works is that you basically have to provide that what website you're getting it from. So for example, in my case, here I would have to put that, okay, this is basically, for example, I want to get a code for this, right? So you want to go there, so you can click on this and it's going to go to this function. Maybe this is not the one that I was looking for. Okay, let's say this one, right? Tesla, Nasdaq. So I want to kind of generate this particular URL, right? So you can see there are three parts of the URL. One is that quote, right? And then you choose which company, which ticker, and then the last part is a Nasdaq. So because it could be either Nasdaq for the US stock or for the NYSE, the New York Stock Exchange. So you're going to provide that. For QQQ, all of them would be Nasdaq, but you can do the same for the other stocks using either NYSE or Nasdaq. So you have to know like which ones where it is listed. So once you have these three parts, you can create a quick macro and you can generate something like this. What do we do here? We just add these three columns together. Now if Tesla, right, for example, it's in C8, is the 8th row, so you can actually dynamically create this macro, and what will generate. So this is what I actually added in in W and X, these two columns. So here you take this U36, which is basically your first part, and C2 is, which in this case is number one, first stock here, Apple, and U38, which is basically the Nasdaq, and then you generate this. And then the other part is that you also are searching. If you click on this, so it's going to take you to the Apple stocks, right? Or Microsoft stock. In QQQ, the number one is actually Microsoft. So it goes there. And then if you look at the, this revenue, right? And you can right, left, if you go here, and then if you click on it and look for inspect, is going to open this console for you on the right side. And in the console, you can basically choose the XML format. So I can go for sources. And let me open the inspect option here. So I want to find out two areas, which is revenue and operating expenses. Sorry, revenue, and I want to find out what the cash flow is, and then I want to calculate what is the free cash flow of this company in the last quarter as percentage of its revenue. So using this formula, where you can actually right click on it and then view paid source, and there you can basically look for so here, if I go back to this table again, so you can basically look for this thing here, and it's going to tell you this class ROXP. So you can actually find out yourself. Just search for this, and it's going to take you there in the source. And you can finally come back and then generate this cash flow. Go back to QQQ. You can generate the Q4 load. Each of this, the whatever is the Q4 2022 revenue, it'll automatically pick up that from there. And now I just launched the spreadsheet, so it's still loading. It's going to take about some time to load all these values. So I actually took a snapshot yesterday. So in the end, it'll look like this. So all these macros and everything aside, so you can basically get this data dynamically every day, or as frequently as you want to open the spreadsheet, and it's going to run in the background. It's going to populate all this, and then you can get a snapshot like a week or so and kind of continue to monitor the change in each of the stocks of your interest. So here I wanted to kind of capture all this different data for the PE, for the EPS, the revenue, the free cash flow, not all of the data, just this much, and then calculate that what's the free cash flow of the revenue for this companies in the last quarter. And this is basically, you got this 1.56 billion of the free cash flow out of this much of the revenue in the Q4, and your free cash flow divided by revenue is 2.96, right? Now I want to see that which ones are like higher. So that means that I want to kind of capture the company which has the highest free cash flow in the last quarter compared to as a fraction of the revenue, and then I want to see that what is their PEs and what is their market caps, right? And that's what I came up with this table. So if I go back and show you that this basically is the snapshot of that particular table, and I found out that if I can filter the cash flow at least 20%, I believe it was 20%. Let me just check what's the filter I used here. So here, yeah. So the cash flow in this case is greater than 18%, okay? 18%, so your cash flow as percentage of your revenue must be at least 18%. And then you can find out that these are the companies from this list. Now, this is your first filtering criteria, the two filtering criteria. Other thing, actually, you want to see that the PE of that company must be not very high. So obviously QQQ is an index where it's a growth-based index in NASDAQ, and the growth-based index, you want to pay more multiple or PE. So all the Nasdaq companies have a higher PE compared to S&P. For S&P, you'll see 13, 14, 12, that kind of PE for most companies except technology. I mean, the growth companies like something like XLY or discretionary growth companies, those are like more higher PE. But here in Nasdaq, most of these are like either high PE or actually they have a negative earning. S&P, the company would not be listed in S&P if the EPS is negative, but in Nasdaq, no problem, you can be. So that's why you have to be careful. Right now, the environment is such. So if you look at like last 2 weeks ago, what happened was like when the bank crisis did take place, then people actually flocked to QQQ. Like a lot of money got parked in 4 or 5 stocks in QQQ, which is the first 4 or 5. Why? Because look at the cash flow it generated last quarter, 1.56 billion. So they are banks, so they don't need cash, right? They're having this cash right in their hand because they're generating this income from the software, from the licenses, from the advertising and all that. 28.19 billion for Apple. Amazing. That's 24% of the revenue is in cash. As free cash flow. This free cash flow is after all this stuff's done. So this is basically generating cash every quarter, or in just as a Q4. So that's why these companies like Alphabet, Nvidia, 1.3, 22%, 23% of the cash flow of the revenue is in cash flow. Alphabet, despite all these problems they have right now, 20% still. Amazing. So that's why companies actually moved. I mean, the investors have moved to these companies. And I want to figure out that that's the case. If it continues to happen, if there's a correction again happens for some reason, then what are the companies Again, I mean, basically, if I want to invest for the next few years, I want to see that, okay, if I want to be safe, I don't want to be in a companies when there's a commercial loan related problems coming up in the next few quarters, and companies going to go bankrupt, you know, and then the banks are out of money, people are taking away money you deposit. So there is a safety net of this QQQ, which actually both grow as well as your money is not going to be lost, right? So that's what the investors are flocking to these companies. I want to find out which companies has a good floor, means which companies have, like PE is not blown up, so that when people have to sell those PEs, the companies which are very high PE, they're going to get sold off fast. Why? Because even if the multiple you're willing to pay that 30, 25, 30, 35 multiple, then if the earning goes down, obviously earning will go down when the economy contracts, then your price is really low, right? So your you basically get lower earning as well as lower multiple. But if you're looking for companies which are already at a reasonable multiple, reasonable PE, this is all trailing PE. So if there's no growth in the earning happening, and also even if there's a regression happening, you're looking for a multiple, lower multiple PE, then your downside protection is better. That's why I want to find out the company which is a sweet spot between the high cash flow as well as not so crazy PE. So I did this heat map. The heat map basically says that here the PE is below 30, and obviously not negative. So it's actually doing the positive earning, and the cash flow is high, right? With that criteria, I think the PE criteria was 30, I believe. Let me just double check that. The filter here is also applied between 5 and 30. Yeah, perfect. So 5 and 30. And then this one is the delta to 52 weeks, as I explained earlier. Red means is it's more than 20. 5 means it's yellow, and then heat map, and then the 0 means green. So that's how you can kind of see the shades of the colors. And the cash flow is at least 18% as we checked. So alphabet is actually here. I mean, this is all in order of the alphabetical order. So you can see they can kind of pick up the color where you are like seeing the less number of less red shade and more yellow green shade. That's better because you're not going to get any all green. That will be very unlikely. So I see Broadcom here is pretty sweet spot, right? Like 2.2 percent from his 52-week high. That means that it's actually doing well. The sentiment is good. Technically it's in a good place because it's making higher highs, or they actually make new highs in 52 weeks. So that's good for technically. Then the second part is it's PE. PE is 21, is not really good it's a trailing PE though, but 21 is pretty expensive for cheap stock. Typically is below 15, 16. Even actually, in a good early days when the chip stock was cheaper, it was 12, 13. Now it's 21. It's expensive, but look at this cash flow. It's 36% straight. So I think Broadcom is a place, but I would rather have a little bit lower. The Cisco is actually a little bit lower, but it's also a very good cash cow, right? Cisco. So I'd not, and it's 7% away from the 52-week high. So I would say Cisco is a little bit better choice here than Broadcom, but obviously Broadcom has that high beta compared to Cisco, which is pretty boring, right? But Cisco, you get a good dividend. Broadcom also, you get a good dividend. So both of them are actually good companies here. Then let's see what else we have here. Fisher, I think it says, I'm not sure if this is a good one. Honeywell, it's 15% away from this because industrials got sold off. So the Honeywell 26.6 is a little bit high PE, I would say. Gilead Science is also a little bit high PE for this, but look at this cash flow, it's great. And okay, so what else? Okay, this one not bad, right? The Regener. Okay, there are three. This one as well, the Vertex Pharmaceutical. I mean, the pharmaceuticals, the good big pharma companies are getting bought as well. In the last few weeks, last couple of weeks or so. So that's why they got a little bit of PE bump. But I would say that not a bad choice. Intel as well, but 17 PE for Intel with a very low growth. I'd not be very big fan of Intel at this point, but yes, you can consider that. Look at this 62 weeks. So it's basically bottomed around 25, 23. So you get a chance and to buy Intel at 27, 28. I think it's a pretty good deal. So these are the QQQ companies, right? So you can see that's I can sort of like filter out some of these more interesting companies here. So which basically tells you that okay, if I have to choose certain companies from QQQ, where I can basically, Apple is also there, right? So Apple is right there as well, along with Amgen and Alphabet. So these are all quality companies where the PE is not outrageous. So that means that you have some sort of floor. I mean, if Apple holds its earning, which usually does, and China coming back, it might be happening. PE means if it doesn't actually, it just holds its earning or it just got a little bit of PE downgrade. So if you hold, if right now the price is around 160, right? So with a 28 earnings, so I guess it's around close to $6 earning. So if I keep the $6 earning, and if I reduce the multiple a little bit to 25, 24, you still get $150 stock, right? 150, 45, $150 stock. So you got $15 of your if you buy it today, is your downside, if it holds the earning, of course, right? Versus if you buy something else when the earning goes down drastically and the cash flow is negative, you might actually lose all your money if the things go really wrong. The other one you can see here, the other one that I created the same way is XLI, which is the industrial. But if you look at the QQQ, the other thing that is important here to note that how many greens are there in the column N, right? There are like hundreds of greens. I mean, not hundreds, but total I counted close to 75 of the 100 stocks are green, right? And that's 75% versus XLI. If I look at it, XLI has a similar thing, but I'll go through that a little bit. But XLI has around 50%. I think there's 75 stocks here. Out of the 75 stocks, I counted that many of them are already in the NASDAQ. So if you exclude the ones which are in the QQQ, right? So if you look at this, same thing. But if you have this QQQ as if you look at the QQQ percentage, here it's somewhere over here, you should see that S&P. I think this is the S&P weight and this should be the QQQ weight, I believe. Format. Right. Yeah, I think this is probably this is the S&P weight and this is the QQQ weight. Is that correct? No, I think I probably messed up here somewhere in the formula. Let's see what formula I used here. Yeah, I think I did not use the right formula, so I'll delete that. Right. Anyway, so here, if we look at this overall, so these are some of these companies. What I was getting at is that are also part of the QQQ, and if you exclude those companies here, then you have around like out of around 12 companies on the 75 as in QQQ. So out of the remaining 63 companies, only about 31, 32 are having the positive cash flow, right? Green. I mean, green positive cash flow means here in this particular case it's over 10%. That's what I believe it's. Let me just quickly check. If I go here and look at the column format, conditional formatting. Yeah, so if it's a more than 10% is green, right? So the stake is lower here in XLI versus in QQQ. Even the lower stake, you only make around 15%, around 40% to 50% companies are making 10% plus positive cash flow as a fraction of their revenue, right? So if I kind of sort out in the same logic here, my filters are as following. If I go back here, so filters are PE, %20 or more, the cash flow, so that's basically the same, and PE is So I guess I don't have a PE ratio, so I use all the PEs. All right, even if you do that, then what happens here? Yeah, so you have this, some of the companies showing up here. So delta from the 52-week high. So you have a 3M. Now if you look at 3M, it's 51% from 52-week high, down 51% from there. So it's in pretty bad technical shape. Whether it actually is a falling knife or it found the bottom, nobody knows. So I'll not go further, but you can see that it has the best, one of the better positive cash flow and the PE combination for 3M. CoStar, CSX, Emerson, these are a few of the companies, right? Some of them are. Honeywell was also in the QQQ. 26 PE is a little bit high. Then you have this aerospace company, Homet. So I would not specifically be attracted to any of them. Maybe Emerson a little bit because of its it's not too far away from the 52 weeks high, but most importantly, the cash flow is pretty good. The PE is also good. So we have to look at the stock and see that why people are not buying it. If it is a good cash flow but still good PE, right? So we need to see that why the PE is so low. Yeah, and that is going to be one of the things that we would look at the chart. We would look at the outlook of this company. 40, if I don't know if that is something. So but you can actually look at this chart, look at this table, and see that that's one way to look at it. And the couple of things so I want to kind of capture from this presentation or this video is that one, that QQQ is actually why people are going there. The reason is the cash flow. So if you had to sort the cash flow as and the revenue, in the QQQ sector, which companies kind of stood out. So we saw that, and then we kind of choose our company based on the low PE and the high cash flow ratio. And you can see that the XLI actually has a bunch of companies which have a high cash flow. However, it's like less than 50% of them has a cash flow 10% or higher, as far as percentage of the revenue, whereas QQQ has around 75%, where the cash flow is 15% or higher, right? So it's clearly QQQ has a more positive cash flow. And the third thing I want to point out, which is more technical, that how did we get to this data and how everybody can pick up the same data, and that's by using apart from the Google Finance functions, but also using the as I mentioned earlier, this import XML function in Google Sheet. And as you can see, in the last 15-20 minutes while we are talking, we got this updated, right? So now we got most of them updated, except maybe one or two. This one is still loading, maybe some error here for charter communication, but other than that, I think we're pretty much all of them are updated for the QQQ. So I'm ready to take another snapshot here. And so that's all I have to say in this video. So hopefully we learned something here, and I'll post more videos as we get grind through this market in the next few days.